Hi. Okay everyone, welcome back. So what I'm going to do with you today is that I'm going to cover with you the topic of budgets. I'm Chia. So this is for those students of mine who are doing management accounting or financial accounting and even financial management. So the topic of budget is what I'll be covering today, and I'm going to briefly talk to you about the purpose, the usefulness and the limitations. Following that, I'm going to focus a bit about how to prepare the operations budget. So this operations budget refers to cash budgets, sales budget, production and overhead budgets and so on. Okay, the other aspect is the financial budget, but I won't really touch on that. Okay, and to end off, we are also going to quickly discuss about the different budget systems. Okay, there are many different budget systems, but we'll only talk about specifically the static and the flexible budgets. Alright? So I hope that would give you enough to help you to understand and to be able to attempt to handle some basic budget questions. Okay, so what actually is a budget? Well, if you think from the point of view of a sole proprietor might have many thoughts about what he wants to achieve in the future of the business. He was going to have things like, what are the goals he would like to achieve, and all these can be simply captured in this thing called a budget. So what actually is a budget? A budget is a short-term plan expressed in quantitative terms. It could be dollar terms, it could be unit terms, it could be in terms of kilograms, it could be in terms of hours, whatever other quantitative measure. The usefulness of a budget is that it assists us in the evaluation of business performance, control aspect of the business, plus planning ahead in the future, and plus it helps and enables the communication and coordination of the different stakeholder departments. Okay, how does it do so? Now if you look at my little diagram here, that when we say operations budget, this refers to budget side, the cash budget, sales, production, overhead and labor and procurement budgets. Now all these budgets are closely connected. In what ways? Now the moment when you prepare a sales budget, people from production budget must ensure that what is required for sale they are able to produce. And not only that, procurement is able to purchase the necessary materials for production to produce sufficient quantities for sale. And that also means that once production has an idea how much to produce, they will then be able to assist in determining the amount of overheads that will be incurred and eventually payable, and even the overhead and even the labor cost that is likely to be incurred. So this involves various departments. So you might have a sales manager involved, you might have production, and you might have the admin, HR manager and procurement people, and even the accountant involved. And all these people will work together, communicate the requirements and coordinate on how are the requirements going to be met. So all these budgets form your operations budget. With the completion of the operations budget, it is then possible to prepare financial budgets. Now what are financial budgets? Financial budgets include your statement of comprehensive income, statement of financial position, which is known as a balance sheet, and finally your cash flow statement. The complete set of all these is then known as the master budget. Okay, so now what we're going to do is that we're going to first touch on how a cash budget will appear like. Now, a cash budget simply comprises of a few things: the opening balance, the receipts, and payments, followed by the closing balance. Now, it might be expanded depending on the question requirement. So it could be broken down by month, Jan, Feb, and March, or it could be by quarter 1, 2, and 3, depending. Now it could have a total column depending again on the question requirements. So what makes up the receipts? Receipts typically will be made up of cash sales, collections, and any proceeds from sale of asset or other collection. The sum of 1 and the items in 2 gets you the total cash available. And what about payments? Payments include any amount to be paid. Adding up these Adding all these gets you total cash available. Taking this minus against total payment gives you closing balance. Closing balance is then brought forward to the following month, and where what you do is that you add on to the following month's receipts, that gets you the following month's total cash available, minus against all payments, that gets you a closing balance. Closing balance goes to the next month or next quarter depending, and then what you do is that you add to all your receipts, that gives you your total cash available. With your total cash available, you minus against the total payments in March, and that gives you finally closing balance of the month of March. If you're going to construct the total column, that's quite simple. Just beware that the opening balance in the total column is taken from the very first quarter or the very first month, and the closing balance has to be taken from the last month. Quite simply put, because the total here, the total column, is for the period Jan to Feb. Jan, Feb to March. So total means that the opening balance has to be from the first month, closing balance from the last month. Once you have that, then it's quite simple. Receipts is the sum of all receipts, collections, sum across, that gives you a total receipts and total proceeds from collection. Sum up all these, that gives you 2650. Do not try to sum across and get this, because you can't. Okay? Now, so the important thing is ensure that you sum up all these, you get this. Okay? You can't verify whether this is correct yet now. Minus is against all payments. This gives you your closing balance, and this total payments is obtained by summing across. Okay? So take 2650 minus 520, you get 2130, and so long as it is the same as the last month or the last quarter, we say that it should be quite correct, unless there are certain mistakes, not this number. Okay, that is the cash budget. Now, then how is it that the sales amounts are derived? How is it that we know that the cash sales is X dollars, collections is X dollars? Well, that's because you prepared this thing called a sales budget. Now the sales budget is broken down by month, Jan, Feb and March. It can be broken down by quarter again. Alright, so a typical question might give you the sales of the respective months, and further give you instruction to say that 20% of sales is on cash terms while others on 1 month credit. So you might see something like this. If the total sales is 1000, 20% could be cash, 80% credit, and February same thing, 1200 multiplied by 20% gives you cash, 80% is credit sales, and so on. Okay? Now when you translate that into cash budget, it looks a bit different. Why? Because the cash sales in Jan will be treated as, of course, collection in January under the cash budget. However, the $800 of credit sales would only be collected in the following month of February. If you look at the month of February, the credit sales of 960 will only be collected in the month of March. Alright? So such criteria you have to be careful of. Okay? Because that will influence how you ultimately fill up and complete the cash budget. Okay, so that is the sales budget. Let's move on to the material procurement. Now the material procurement budget is prepared based on the production budget. Okay, it's based on the production requirement. So therefore you need to know what is your one completed unit. Okay, and how many raw materials does it require? Is it 2 kilos or 10 kilos? In my question, I'm going to use 2 kilos for example. So which means that according to my earlier example, the production requirement is going to be 1003 in Jan, 1260 in Feb, 1430 in March. So multiplying by 2 tells me my total production requirement. Okay, and then adding to my desired closing stocks, that tells me what is my total requirement. Okay, and after minusing my opening stocks, that tells me what is the total purchase requirement. I repeat the same for February. Whatever closing stocks you have in Jan, you fill up in opening stocks of Feb. Whatever closing stocks in Feb, fill up as opening stocks in March. Now, the opening and closing stocks may not be so simply indicated like this. There might be some calculations involved depending. Okay, so this is generally how it's prepared, and then once you have the total purchase requirement multiplied by the cost per unit of raw material, then that gives you the total material purchase cost. Now when this payment will be made depends on whether there are any credit terms. If there are no credit terms, for example, that means if material cost is 265, then cash budget in January you have to indicate 265, March you have to indicate that payment for material will be 262, and payment for March will be 296. However, if the question tells you that there are no terms, or there are terms, and those terms are 1 month, then how different would your completion of the cash budget be? Now, if there are 1 month terms, then you have to be careful that the 265 of purchases will be payable in Feb. 262 of purchases in February will be payable in March. So that depends on your question requirement. The question requirement will define how you will complete the cash budget. Going on, now we have the next item, which is the production budget. Okay, so the production budget, it should rightfully come before the material budget, and it should come after the sales budget. So that means only with the sales budget then you will know what is your procurement budget or your production budget going to be like, and that influences, of course, your procurement budget, procurement of raw materials. So there is this sequence here. Alright, so at all points your cash budget will have to be updated in order to determine if there is enough cash from sales to pay for all the production costs and procurement costs. Okay, now the production budget is fairly straightforward. You need to have firstly the sale quantity, followed by the desired closing stock. Now how this works is that taking whatever sale requirement, adding to whatever desired closing stock, that tells you what is the total requirement. The total requirement minus the opening stocks tells you what is the production that needs to be made. Now, so using this, repeat the same process for Feb and March. Now, before you can do all this, the question must have indicated something like this and says that sale quantity would be 1000 in Jan, 1002 Feb, 1004 March, 1005 April, for example. So then closing stocks of each month has to be 30% of the following month sale quantity. In Jan, the opening stock was 60 units. So you might need to have such a requirement in order to assist yourself in preparing the production budget. So which is why if you look at my example, if you follow, how do I know the closing stock will be 360? Well, then you have to take 30% of February, and with that, adding the two together, that gives you 1360. Now, and whatever you have as the closing stock in Jan becomes opening stock in in the month of February. And how do you know the desired closing stock in Feb? Same thing, 30% of the following month sale requirement, 420. 30% of 1004 is 420. Repeat the same calculation, determine the production requirement, and do the same for the month of March. So how do you know that the closing stock requirement is 450? Simple, take 1005, which is the next month April sale requirement, multiply by 30%, that gives you your desired closing stocks. And well, that does it. Okay, that is the production budget. So the sequence goes like this: sale quantity, desired closing stocks, less your opening stock, and finally obtain your production requirement. So that's the production budget. Now you have the next thing, which is the labor budget. Now labor budget is derived from your production requirement. Because you know what is the required production, then you are able to determine what is your labor hour required for all of the production. So let's say if per unit you need 2 hours, so take the production quantity times 2 hours tells you the total hours required, multiply by the rate, that tells you what's your total expected labor cost. Now typically the labor cost incurred in the month will be paid in the same month, unless the question says that there is 1 month term, then it might be reflected the following month, depending. Okay, so that is the labor budget. And you have the overhead budget. Overhead budget is laid out in this format. You have, for example, the overhead rate followed by the quantity of production. Okay, so multiplying the two tells you your total variable overhead cost. Add to your fixed overhead, that tells you your total overhead payable. Repeat that for all months. Okay, so that's the overhead budget. Now, the fixed overhead may be broken down into rent and utilities depending on how detailed your question is. Okay, so you might have 2,000 lump sum, or it could be a broken down detail of like 200, maybe 1,008 and so on. Alright, now the whole idea is to determine what is the overhead payable, and which will then flow into this thing called the cash budget. So your cash budget will then capture the total overhead. So you might have something like this, right? Total overhead, which you might see, for example, whatever amount and so on. Same thing, Jan, Feb, and finally March. Right? Or it could be 1 month term, then that means the overhead of January will be paid in February and overhead of Feb will be paid in March. That's also possible. Alright, so we have discussed all that in a lot of detail. Now I'm going to explain to you what's the limitation of budgets. Now, budget systems are not so-called foolproof. They have various limitations. Now, the most obvious limitation of budgets is number one. Now, the usefulness depends quite heavily on the accuracy of the input data. Now, the truth is, if you have rubbish data, that will result in rubbish output. So, the data that is being used has to be fairly accurate so that the budget would of course be a lot more useful. Now, however, budgets have certain issues. It leads to certain dysfunctional behavior. Now, what kind of dysfunctional behavior that may arise? Now, you might have people who build budget slack. Now, budget slack is one of those problems. What does it mean? It means that certain stakeholders or stakeholder departments might build inefficiency into the budget. So instead of having an accurate budget, what some stakeholder departments may do is that they might overstate costs rather than understate, right? So that it's easier for them to achieve. They build inefficiency into the budget so that targets are easier to achieve and they are not as easy to fail. Now, would that be ideal? It wouldn't be ideal, because inefficiency also means that it also increases cost and wastage. So that's not ideal at all. Now, the following issue with budgets is that when you try to have a budget system in place, it also results in people trying to spend to the budget. Okay, a possible mentality could be that the manager thinks that he is given X dollars of budget. If he doesn't finish spending that, he might have to answer for it. So there is more incentive to spend to the budget rather than spending lesser, or spending a lot lesser than what was budgeted, right? So in fact, people might, or stakeholders might be afraid to spend a lot lesser than what was budgeted, and there is more incentive to spend as far as possible, as close as possible to the budget, so that it doesn't result in more questioning being done. All right. So these are some of the limitations, right? And of course, there are many limitations. You could read them up. Now I'm going to touch on the last item, right? So that I can close out this video. That budget systems can be broken down into two types. One is the so-called the static budget. Now, static budget was what I've explained just now. What happens is that such systems, they only have, for example, time. It might have this certain projected amount of performance, maybe revenue. Okay, but then the fact is that you might not achieve this much revenue. For example, it could be that there is massive amounts of promotion, or they couldn't sell as many, correct? So then static budget is not able to capture the fact that sometimes people do sell less, and it's not due to a fault of theirs. It's that, well, you have poor business. Poor business affects your GP. So if, let's say, if due to the poor business your GP fell, gross profit fell, then how do you assess the manager? Do you say that it's their fault that they couldn't sell, they couldn't achieve that profit because they have no customers? Right. So that's one problem with static budget, because it only shows the revenues, the costs, the GP margins based on one fixed level of activity. So if you happen to have underperformed or sold lesser quantity than you should have, then you get penalized, or managers get penalized unfairly. So static budget therefore doesn't allow a fair assessment of how managers perform, and which results in the use of flexible budgets. What flexible budget does is that it creates different levels of revenue, cost, and margins. For example, if let's say sales happen to be of a certain level, then you know that GP could be this much. But however, if sales level wasn't as high, then it's expected that GP might be lower. How low? Maybe not as high, maybe medium level. And if the sale level is really low, then you find that the GP will be at a low level, so that this GP of high level may be for 1000 units, this medium level could be for 800 units, and this could be for 600 units. Right, so you know that, okay, these are the expected GPs. Right. Let's say if a certain manager came in and then his department for some reason sold 1000 units, but then the 1000 units after he sold, he found that, hey, his margins for 1000 units, the actual margin was only this much based on the black line, but the budgeted GP was supposed to be higher. Then what do you do? How do you assess whether this 1000 of actual margin is good or bad? Simple. You compare only budget of 1000 versus actual of 1000, rather than comparing actual of 1000 versus budget of 800, which is not fair. So the whole point is that you want to assess managers based on what if the sale level is low, so how should he have done? You want to assess him on that basis, not like this, you know. Now if you're going to assess your manager based on this, that okay, if the sale revenues fell, but you do not take into account of the fact that he sold lesser because of poor economic environment, and that's very unfair to him. That's the problem with the static budget, where flexible budget gets around that problem by determining what would be the GP if, let's say, the quantity was different. So which means in this case, if let's say maybe another, let's say another situation, let's say the manager came back, he says that he managed to achieve this much of sales, his actual GP was higher, and you know that his actual GP was 600 for 600 units, then you could tell that, oh, comparing 600 against 600 have actual GP versus 600 of budget GP, then you could say that, okay, in this case the manager seems to have done well. Alright, so that's the advantage of a flexible budget. Alright, it takes into account and assesses what you call that, performance based on the relevant activity level. So if your GP was based on 600 units, then flexible budget will provide the budget GP for 600 units and you're able to compare on the correct basis. Okay, rather than comparing actual GP of 600 units versus budget of 1000 units of GP, because truth is that if you're going to compare performance, you should assess budget performance of 600 versus actual performance of 600. That would be fair comparison. Okay, so these are the two budget systems. Of course, there are some other catches with this. Static budget is easy to prepare, but of course the problem is that it has limited usefulness, especially that static budget only provides for one level of activity. So in order to fairly assess managerial performance, you should use flexible budget, because this, although is more time consuming to prepare, but it has multiple levels of budget performance. So that allows you to have a fairer and more precise assessment of managerial performance. Alright, so there you have the two budget systems. Of course, I've not given you the numerical example on this, but now this is basically to give you a quick idea on how the two systems differ. Of course, after this you have other systems like the zero-based system, and you might have the incremental system. So there is quite a huge variety, but well, these two would be sufficient for you to start with. Alright, so with that, now what I'm going to do is that I will end the video by telling you that if you do have any questions after explaining to you all this, don't worry, you could approach me during class and I could explain to you further on this. Right, depending on which subject that you are taking, right, certain diploma level subjects would not require the knowledge of how to prepare flexible budget. So of course, if you happen to fall under the degree programs, please do ensure that you understand how the preparation is done. Okay, so have a good day, and I hope that this has been informative, and do join me for any catch-up lessons if I've informed you. Alright, if not, any queries, do drop me an email, and my email address is wildy231@gmail.com, or you can email me at whichever institution where I'm teaching you at. Okay, that works as well. Okay, with that, I'll see you soon in the next lesson. Right, have a good day.